At this very second, the market is witnessing a decisive, almost aggressive move in the shares of CVS Health Corp, which is currently trading live at exactly $79.10 per share. We are looking at a robust intraday surge of $2.57, translating to a substantial gain of roughly 3.36% from the opening bell. If you have been watching the ticker tape on your Fidelity mobile app or tracking the heat maps on Interactive Brokers, you're seeing a sea of green that frankly contradicts the bearish whispers that have plagued this stock for the better part of the last 18 months. The volume is heavy, already surpassing 4.5 million shares exchanged within the first hour of trading, indicating that this is not just retail noise, this is institutional capitulation and repositioning. The stock opened at $76.02, dipped briefly to a low of $75 where it found immediate support, and has since rocketed to a high of $80.50, before settling slightly to its current level. This isn't just a standard fluctuation, it is a statement candle on the daily chart that demands our full attention. The expectation heading into today, and indeed broadly speaking for the fourth quarter of 2025, was that CVS Health was a dead money trade. The prevailing narrative on forums discussing Robinhood stock trading or among the talking heads on financial television was that this conglomerate had become too unwieldy, too burdened by the integration of Aetna and Oak Street Health, and structurally damaged by the Medicare Advantage reimbursement cliffs we saw back in 2024. Investors expected a defensive, sluggish performance, perhaps a slight earnings beat at best, but mostly sideways chopping action as tax loss harvesting season approached. That was the expectation, a boring, broken blue chip limping toward the year-end finish line. The reality, however, is a violent wake-up call to the short sellers. The reality is that CVS Health has just dropped a bombshell by raising its forecast for the remainder of 2025 and issuing a surprisingly bullish preliminary outlook for fiscal 2026. This disconnect between the sleepy, pessimistic expectation and the vibrant, guidance-raising reality is exactly why we are seeing such a violent repricing event happening live on your screen. The market was positioned for disappointment, heavily hedged with puts, and now those positions are unwinding in a scramble for liquidity. This is the classic pain trade, moving higher, forcing analysts who downgraded the stock 6 months ago to frantically update their models before the close. When you look at the intraday chart, specifically if you use the advanced charting tools on the thinkorswim or Fidelity trading platform, you will notice a massive volume spike right at 9:35 a.m. EST. This wasn't gradual accumulation, this was a gap-and-go scenario. The price action cleared the psychological resistance at $78 with virtually no friction. Why does this matter? Because $78 has been a graveyard for rallies throughout most of this year. Every time the stock approached this level, it was met with a wall of selling pressure from trapped longs looking to get out at break-even. Today, that wall didn't just crack, it was pulverized. This suggests that the trapped longs are no longer selling, they are holding, confident that the turnaround is finally real. It also implies that new money, possibly from Fidelity wealth management accounts or automated rebalancing from Schwab Intelligent portfolios, is entering the fray, recognizing that the valuation gap between CVS and its peers has become too wide to ignore. Let's talk about the specific mechanics of this move. We are seeing a rotation out of high-flying tech and into value plays that actually demonstrate pricing power. And for the first time in a long time, CVS is demonstrating that power. The sector momentum is shifting. For months, investors flocked to Nvidia stock or chased the momentum in Tesla stock, treating healthcare as a funding short, something you sell to buy more AI exposure. But today's price action in CVS signals a reversal of that flow. We are seeing funds flow out of overextended growth pockets and into the healthcare services sector, specifically targeting companies that have reset their baseline expectations. CVS, having lowered the bar significantly over the last 2 years, is now stepping over it with ease. This brings us to the core fundamental thesis that is driving this price action. Most retail investors, perhaps those of you using SoFi Invest or Robinhood for casual trading, tend to view CVS merely as the corner drugstore where you buy toothpaste and pick up a prescription. If that is your view, you are missing 70% of the story. The retail pharmacy business, while visible, is a low-margin, high-headache segment plagued by theft and labor shortages. The real engine, and the reason the stock is up over 3% today, is the insurance arm, Aetna, and the pharmacy benefit manager, Carmark. The news hitting the wires today about the raised guidance suggests that the medical loss ratio, an MLR, a critical metric that measures how much premium revenue is paid out in claims, is finally stabilizing. For those who remember the carnage of 2024, the MLR was the primary villain. We saw utilization rates spike as seniors rushed to get elective surgeries they had postponed, blowing a hole in Aetna's balance sheet. The stock collapsed from the 80s down to the 50s during that dark period. Investors using interactive brokers' stock trading tools to short the stock made a fortune as management cut guidance quarter after quarter. But markets are forward-looking mechanisms. The market doesn't care about the surgeries paid for in 2024. It cares about the premiums being collected in 2026. The guidance update today confirms that CVS has successfully repriced its insurance contracts. They are charging more, the premiums have caught up to the cost of care, and the margins are expanding. That is the alpha signal that algorithms are buying today. Furthermore, we need to discuss the breakup narrative that has been floating around. There has been persistent speculation that CVS might split its retail and insurance businesses to unlock value. While management has been coy, the strength we are seeing today in the integrated model suggests that the synergy thesis might finally be bearing fruit. The acquisition of Oak Street Health, which was heavily criticized as too expensive at the time, is starting to show meaningful contribution to patient retention and cost control. By funneling Aetna members into Oak Street clinics, CVS is capturing the full life cycle of the healthcare dollar. This is the vertical integration dream that was sold to shareholders years ago. And today's price action is the first concrete vote of confidence that it is actually working. Let's take a moment to address the retail trader sentiment. If you check the social sentiment indicators on SoFi Active Investing or the chat rooms associated with Robinhood crypto and stocks, the mood on CVS has shifted from despair to cautious optimism. For a long time, CVS was the stock you owned because you had to. It was a dividend aristocrat that stopped growing. Now it is becoming a momentum trade. We are seeing call option volume, bets that the stock will go higher, spiking in the 28, 2, and 25 strikes for January expiration. This gamma exposure forces market makers to buy the underlying stock to hedge their positions, creating a feedback loop that pushes the price even higher. This is technical market mechanics 101, and it is playing out right in front of us. However, we must remain objective. While the expectations were low and the reality is a beat, we cannot ignore the broader macroeconomic pressures. The Federal Reserve is meeting later this week, and the bond market is jittery. High interest rates hurt companies like CVS that carry significant debt loads from their acquisitions. If the Fed signals a higher-for-longer stance yet again, or if the bond yields spike, this rally could fade. Investors using Fidelity ETFs or Fidelity mutual funds to gain exposure to the sector need to be aware that healthcare is often used as a defensive proxy, but CVS has been trading with the volatility of a tech stock recently. It is not the safe haven it used to be. It is a turnaround play, and turnaround plays are inherently risky. The disconnect between the drugstore perception and the healthcare conglomerate reality is where the opportunity lies. Most people don't realize that CVS is one of the largest companies in the world by revenue. It generates more revenue than Apple stock in certain quarters. Yet it trades at a fraction of the multiple. Why? Because the market hates uncertainty, and CVS has been an uncertainty factory for 2 years. The Pharmacy Benefit Manager (PBM) business is under constant scrutiny from the FTC in Congress regarding drug pricing transparency. This regulatory cloud hangs over the stock like a wet blanket. But here's the contrary take. The market has arguably already priced in the worst-case scenario. The stock traded down to levels that assumed a complete dismantling of the PBM model. Today's guidance raise suggests that even with regulatory headwinds, the cash flow machine is intact. Now I want to pause the analysis for a second and get a pulse check from you. This move today is significant, but I want to know where you stand. Comment below how many shares of CVS Health you currently hold,